we had to post the recording before the end of the bootcamp so that those guys that missed the day one, because you know that Fridays are usually busy days, right, for so many individuals, and before they get home, and settle down, it's already late and they will get tired. So that's why we have to post the recording before time, right? So I hope you guys went through the because I had to check the channel. I saw about 40 views. That means some of you are actually diligent to go through the recording for those that came late and all of that, all right? So welcome to the day 2 of this bootcamp, right? Tonight we're going to go a bit deeper, right? So we're going to go a bit deeper. All right, I told you that this bootcamp is not like the regular bootcamps you see out there. It's not the one who will come and tell you perspire to aspire, all those things that are not relevant, right? We're going to the meat. Like I said yesterday, that when you kill a chicken, right? Maybe you serve a chicken like with all the parts. You usually find a chicken intestine, the legs, the head, the chest, and all of that, right? But when someone wants to give you the meat, he's going to put his hand into the part of the chicken and bring out the most fleshy part. That's what I call the meat. Like, it's not just giving you the leg and those bony parts, just give you the meat. That is what this bootcamp is about. So I want to just give you the meat, because the goal of this bootcamp is to help those that are having one or two issues, right? So we're going to just go straight to the point, right? So today we're going to talk more about institutional trading, all right? We're talking about institutional trading and all of that, right? So we're going to start with the smart money conspiracy theory. I know you guys will find that topic very, very funny. Like, what do you mean? What do you mean conspiracy theory in forex trading, right? Please give me a moment. Let me bring my phone closer. Like, I want to have my phone closer. Just give me a moment. All right, sorry about that. I had to get my phone closer. I'm using my system, so I only need to have my phone closer so I can be monitoring it. All right, right. Yeah. So, like I was saying, we're talking about the smart money conspiracy theory, right? Now, you guys be wondering, what does conspiracy theory have to do with forex trading, right? What do I mean by this? The truth is that there is a conspiracy, right? And that's the reason that many traders are not actually profitable, right? A research was done in this business, and it was found out that 90% of traders are not profitable. How is the truth about it? Right? If you go by population, right? If you go by population, 90% of traders are not profitable, right? One thing you should understand is that being profitable is not, making $10 today or $10 for 1 month. Being profitable is being able to pull out the money from the market year in and year out. That means you're making money in the month of January, you're making money in the month of February, in the month of August, and so on and so on. The same way you can make your profession, like as an engineer, you can make your profession your full-time source of income, right? But that has not been the case in trading, right? Because of the conspiracy theory. And we'll be trying to unravel that. And there are actually a lot of them, but one of the reasons I feel that many traders are not profitable is because of this thing I'm about to talk about. Now, I want to ask you guys a question. Have you ever been in a trade, right, that you take a trade and the market, maybe the market was the market was like, you are planning to maybe sell the market here, right? And then maybe you put your, so those of you are trading limits like me, because I'm trading more. I trade more with limits, like what I'm saying limits. I don't really do my execution. So you put your limits here, and then you expect that price will drop from there, and then price does this, takes out your stop, but just takes it out, and then not drops. If this has happened to you before, just that type of tools in the group, let us know that you guys are we are on the same page. We have had this kind of encounter where you are in the market takes you out and then reverses almost immediately. Drop some ones or twos in the chat. Let us know if you guys can relate to what I'm saying. Let's drop some one. Yeah, drop some one. You guys experienced such thing before? Wow. I have experienced it a lot of times. Like, I've lost money because of that. And sometimes, you see, now, there's a conspiracy theory by the guys that are called the smart money. Right. Now, I want to say something. It is true that 90% of traders are not profitable. That is based on numbers, but not based on the allocation of funds. Right. Now, the conspiracy theory is actually an explanation for the reason why many traders are targeted. Right? There are a group of traders that are targeted, all right? And the group of traders that are targeted are, okay, someone has not traded before, don't worry. You will get the hang of it maybe as we continue, right? So the reason why many traders are not successful is because many traders are targeted. And what do you mean by target? That means there are traders that are targeted. That means retail traders are the targets of this theory, this conspiracy, right? Retail traders. Now, who is a retail trader? A retail trader, before trading became electronic, right? The forex market was available to only people with large amounts of money, right? Those people, it was only affordable to banks because banks needed to, change their currency. Big businessmen, for instance, now that there are some companies that produce phones, right? If I have a phone production company, the chances are that the instruments or the things I will need to produce that phone will not be found in Nigeria, right? So I would need to buy it from other countries. And now to save the cost, instead of using most countries don't accept naira, right? So I would need to change my naira to dollar, right? To buy from them, to buy the products of my phone and then import and then all of that, right? So that was why forex came about. It initially came about by big companies that are trying to get things from different countries, like a business stuff, right? That's how it came about, right? So they realized that you could actually use that to your advantage. So many people started realizing that apart from exchanging currencies because of purposes of transactions, you could actually make money off the prices, the rate and the prices of different currencies and all of that, right? So let's assume that you bought your phone when dollar was at 400, right? And now dollar has grown to 800 per dollar, right? So that now your phone, you actually bought your phone at a cheaper price. And even if you want to sell it, you're going to sell at that 800 currency, right? So that's what I'm talking about. I'm talking about the conspiracy theory. The retail traders are the target of this market. That is why many are not profitable, because the retail traders are targeted. And why are they targeted? Because the same way that you need, the same way that when you have, you have some things in your shop, right? You need someone to buy from you before you can sell, right? You need someone to come and buy your phone before. That means you cannot sell your phone unless someone is willing to buy it, right? So the smart money traders are target. They usually target what? The retail traders. These are the targets of the smart money traders. Now, who are the smart money? The smart money are the guys with the money, right? The guys with the huge orders. Right? So smart money cannot be defined with. Can be defined as smart money are the folks with big funds. When I'm talking about big funds, I'm not talking about $1 or $2 or $3. I'm talking about millions of dollars. And now, who are they? Like, how can we know them? Right, number one, we have all the banks. These are the people that I call it smart money. So these are the guys that are trading against you, right? These are the guys that are targeting you. These are the guys. That's why I say this that trading is a personal journey. The truth is that we are all trading against each other, right? Like that's why two people can have the same strategy. One person is buying and the other person is selling. Now, the person that is buying is wishing that his buy will hit to take profit. and the person that is selling is also wishing the same thing. Now, what happens is that when the person buying eventually takes his profit, someone else has lost. That is, for every trade you win, someone lost that trade, because we have millions and millions of people that trade the same financial market. That means each time you are trading GU or EU, there are millions of people all over the world trading EU and GU at the same particular time. And the chances are that they are not in the same side as you are. Some are probably buying when you are selling, some are probably hedging and all of that, right? So you must understand that forex trading is a personal journey. It is you against the world. That one you should just know. Although that we try to sometimes have teammates, academic partner and all of that to make our journey easier. But the truth still remains that we are trading against each other, right? Especially we are trading against these guys, the smart money and all of them, right? Now we have the banks, we have the hedge funds. These are the smart money guys now. We have the hedge funds, we have the multi-million-dollar establishments. Right? It's not those BB companies. Do you know that I remember something that happened. There was a time that Elon Musk, right? He talked about his Tesla, that they were accepting crypto, something like that there were certain crypto payments for their products. Immediately they said that the price of cryptocurrency at that point it went up. So these guys, they have the influence and the money, not only big funds, they have the money and influence. Right, they have big funds and influence to control the market. Yeah, control the market. So these are the guys that are actually targeting you. You have the banks, the hedge funds, and etc. Right? These are the guys that actually control the financial market. And believe me, these guys are not trading with small funds. They're trading with billions of dollars, like billions of dollars. And what these guys are trading with. All right. So now these are the guys that are actually trading that are actually called smart money. So if you want to know more about them, you can simply come to Google and type top currency traders by volume, right? If you want to know some of the big guys that they are actually smart money, these are the guys that have money. So you want to know the top currency traders by volume, not by number of traders. I'm talking about by money, like the amount of money that they have in the market. For instance, if you have, like in companies, we have shares, right? So the person with the highest shares usually controls the major activities of the company. That is the same way the fractional market is. But we have guys that actually control a large percentage of market. And these are the guys, right? They actually control a large percentage of the market. You can see they are listed there. So if you come to this point here, you can see their names somewhere around there, right? These are the smart money guys. So by volume, we have JP Morgan. This analysis was done in 2020, right? So these are the top currency traders. You can say they did not mention anybody. They mention the guys that have the money to move price. And these are the guys that are targeting you. They're the guys that make price to go against you and then go your direction. These are the guys that actually manipulate price. They're the guys that do it. So we have JP Morgan, we have UBS, STX, Deutsche Bank, Citi, all of them, Goldman Sachs, Goldman Sachs is actually in a lot of deep shit currency, and all of them, right? So I think currency, the highest of them all is JP Morgan. They have, and notice something about this. Notice that among all these smart money entities listed here, notice that we have USA. USA is, JP Morgan is based in the US. We have USA one position here. We have USA again. We have USA again, that is 3, USA 4, USA 5, USA 6. So 6 of these top entities that trade the financial market are in the United States. That is why the US dollar or the US economy controls the market so much. That is why when you have a news or something of that sort that affects the United States, the market go crazy, because even pairs that are not, that don't have USD attached, like GJ, right? Something like GAUD, that is British pound against the Australian dollar. Sometimes if you have a news event in the USA, you will see those markets going crazy because these guys control the market. They have the volume of the market, right? So these are the guys, what we call the smart money entities, right? So what we call the smart money entities. All right. I'm trying to get something. Come in. I'm trying to look for something. Um, all right. I've seen what I'm looking for. I'm going to show you guys what smart money order looks like, right? I'm posting it in the group so you can have a look at what I'm talking about. So look at it. So if you check the group now, you will see what I just sent to you guys. You will see a USJPY trade. You can see the lot size. You can see the equity. You can see that this is actually an equity of $2 million. Imagine the lot sizes. That is using how many lots is that? That is 1 million lots. That is three. That is 3 million lots. Right? I don't think that a single person can have this kind of quantity, trading with this kind of lot size at once. Wow, that is not 2 million. No. That is $2 billion. But it's nine figures after the decimal. So you can see that that there are guys that actually control. That's what the orders look like, right? Now imagine that you are buying USDPY with maybe 0.1 lot, and someone is selling with this kind of lot size. Where do you think the market is going to go? Is it going to go in your favor or against you? Just type it in the group. What do you think? If you're trading the market with maybe 10 lots, and someone is trading the market with 3 million lots against you, where do you think the market is going to go? Is it going to go your direction or against your direction? Simple. It's going to go against you. So these are the guys that are targeting you. They are called the smart money entities. And you can see how they actually control the market. Right? I think some time ago, these people were sued, right? Let me go get it. I think it was JP Morgan or so. Yeah, let me just search it again. JP Morgan sued. Yeah, for my betting charts. Yeah, JP Morgan sued for manipulating charts. Right, you can see that. All right, you can see it. JP Morgan at a point, look at it there. This was the news, sometime in 2020. JP Morgan actually, this is what I'm also the guy that there's a conspiracy theory, and these are the guys that are manipulating price. Look at it here. JP Morgan, all right, manipulated. I think was it metal or was it gold or so, something like that. It manipulated the market, and the people that were in the market, they found out that that smart money was involved. I've told you that when a smart money entity is trading against you, the chances are 90% that you're going to get stopped out, right? So look at how these guys they manipulated price against the and they were sued, and the people that sued actually won the case, and they have to pay $920 million for manipulating price. And this is just one of the ones that were caught. So we have guys that actually manipulate price, and they target you. Now, why do they target you? It's simple. Because they want someone to take the opposite side of their trades. I told you that for every buy position you take, there must be someone willing to sell. Before the financial market became electronic, right? Like when I was listening to one of my mentors, Mark Douglas, he was telling us that before you take a trade, they would have to go and check the whole Chicago Board of Exchange to see someone that has the opposite side of your trade, or else your trade will not get filled, right? That was how trading was before. Because I told you earlier that if you go to your market now and maybe you go and carry maybe rag jeans, right? Maybe you're into fashion, you're selling rag jeans, all right, in the market, and you want to sell it. Until someone is willing to buy it, there will be no sales for you. That's the same way it is in the market. Before you buy, someone must be willing to sell. And thank God that we have millions of people. So there is no way that there will be nobody willing to sell out of the millions of people in the whole world in that market, right? It's just like now, as I'm speaking now, the chances are that someone has died between the beginning of this call and now. And there's a very great chance that someone has been born between now and there's also a great possibility that someone just proposed to his fiancé between when we started this call till now. That is how it is, because we are so many. And being many, we have a lot of wills, a lot of decisions, and all of that. So like I said, for your buy order to be filled, there has to be someone willing to sell it. Now, smart money have a lot of positions, like they have money. They are not selling with your 10 lot or 0.1 lots. They are trading with millions of lots. And now, if smart money wants to sell, how are they going to make someone to buy from them? So what they do is that they target retail traders. So what someone does is that you know that when you're in a trade, like if you're selling this market, right? I told you yesterday that when you buy maybe your iPhone at $1,000, all right? When you sell your iPhone at $1,000, maybe you sold your 15 iPhone at $1,000, and then you go to the market, and then the price increases to what? 1,500. You have made a loss because you need to add extra $500 again to buy again. You understand? So when you sell something, maybe you sell an asset and the price goes against you, automatically you will have to buy at a higher price. So smart money wants to sell and they want to force people to buy from them. And I remember that I said that whenever your stop loss is hit, automatically you have done the opposite action. So if you are buying and your stop loss gets hit, you have automatically sold. That's why you made a loss, because the price that you have sold at a higher price. So whenever you're trading, you're actually buying and selling at once. So when you click buy, you're actually buying and selling at once. So when you're selling, you're going, whenever your stop loss or take profit gets hit, that is when the other does the opposite and gives you a profit or loss. When you're buying and the market goes against you, you have sold at a lower price. Just have that in mind. So smart money wants to force you to take the opposite side of your trade. And how do they do that? By taking your stop loss. So smart money deliberately, they would move price against you to force you to take the opposite direction of their trade so that their trade can be filled. Because if smart money want to sell with 1 million lots here and no one is willing to buy there, their orders are not going to be filled, because right now we have an algorithm that controls the whole thing. So if you're buying, you don't need before trading became electronic, when you want to buy, maybe want to buy gold, right? They have to go and look for someone willing to sell. That's manually, right? They will call. So do you want to sell gold? Do you want to sell gold? All of that, all right? But now the computer age has made it so easy. So when you click buy, the computer does a manual search to get where to pair your buy orders for a sell and then give you your position, right? So smart money wants you to take the opposite side of their trade. And what they do is that they manipulate price against you, and when they are manipulating price against you, you now buy from them, and then they cannot sell comfortably. So if smart money want to sell with 1 million lots, what do? They will make price to go against you. You know, to sell with 1 million lots, right? They don't sell with 1 million lots, right? And they need to sell with 1 million lots, and they need 1 million lots of buys, right, from retail traders. So what they do is that they have to do what? They manipulate price against you. So this is 1 million, not 11 million. So they need it. I know that. So if smart money wants to sell, they need 1 million lots of buys from retail traders. And what they do is that they simply do is manipulate price against you. And then when you have done that, they have forced you to buy at that bad price, and then they cannot sell comfortably. So they're not forcing. Just like now, I want to sell my jeans, and I go and force people to go and buy from me. Maybe I go and carry a gun and point at, yes, if you don't buy from me, I'm going to die. So that kind of stuff, right? That is just going to so they have to force you to buy by manipulating price against you. So that is the conspiracy theory. That is why main traders are not profitable, because we have entities that are consistently taking price against them. There's a movie I watched. No, sorry, it's a series, right? The name of the series is what's the name of the movie now? It talks about trading and all of that. What's the name of the movie? Billions, right? It talks about trading. How hedge funds, how they are pushing price. They will go and have a meeting, deliberately push price. They are controlling price and all of that. If you watch that movie, you will understand what I'm talking about. You understand it. So hedge funds also have the money to move price a significant direction. But you know, the hedge funds, they don't really trade the way we trade, right? they're usually buying and selling at once. No, I don't know how they really do it, right? I don't really understand, but to my understanding, how hedge funds make money is that they like to make price within a range. That's what hedge funds usually do. They love ranging markets. So they love seeing market doing like this. They're buying and selling, buying and selling. That's what they usually do. Why? Because they want price. Maybe they assume that this hedge fund is involved in the production of gold, right? And they want gold price to not be too high for people to buy and not too low for it. So they will just be buying and selling, making the price of gold to just be remaining at a particular bouncing. They just buy here, sell here, buy here, sell here. While they're not trying to keep the price of their commodity to be fairly stable, right? So it's not be too difficult to deliver it to their customers. So hedge funds, how they trade is actually different from how other people trade, right? They usually want to see price go up, go down. So just be within an area where their products can still be on demand or suitable for their customers, all right? So that's just about hedge funds. That's what they do. So they also have money to manipulate price. That's why sometimes you see markets pierce a range and then drop down and all of that, right? So that is it. So now we have understood that there are guys that actually target us. Now there's a good news. Can someone type there's a good news? And now this might have been depressing. Now there are people that are targeting you. Yes, you have been targeted. You have snipers, you have assassins that are actually after you, and the name is Smart Money. So now we have a good news. Just type we have a good news in the chat. There's actually good news. Right? So you have to talk about the bad parts. Just type there's a good news. Just type there's a good news. Type there's a good news in the chat. Let us see. I want to tell you guys the good news about all this whole conspiracy theory. All right. Just type there's a good news. All right. Let's go. Let's go. Same from Mr. Emmanuel. That's the good news, right? Let's go. All right. Now, the good news is that since we now have the invention of electronic charts, right? We can foresee what Smart Money is doing and follow them. Now, I want to ask you a question. If Smart Money is selling, is it not wise to follow them and sell? There's usually a popular saying that says, if you cannot beat them, then join them. That is the whole idea of institutional trading. If you can't beat Smart Money, join them. And this is where we talk about Smart Money concept. Right. Now, there is a way to follow Smart Money. That means when they are buying, you are buying, and when they are selling, you are selling. That is how we make money using these conspiracy theories. Now we have understood what they do. All right. Now, we now have to do what? Follow them. Now, I want to say something. You cannot trade Smart Money effectively when you trade with indicators. Why? Because Smart Money don't use indicators. They are only looking at price. And they're looking at price levels. They're not using, that's the only thing Smart Money looks at. Price levels. That's what they're looking at. They don't use indicators. They don't use your MACD, your stochastics, your crossover, all those blah, blah, blah. They don't use it. And this is going to be like the filter for those of you guys that will really benefit from this. Because some of you guys have been sold that story that you have to use indicators when it crosses, blah, blah, blah. Smart Money don't use indicators. Why? They have the money to move price. If I had the money to move price, why would I be waiting for a moving average cross? Or why would I be waiting for the moving average to tell me when it's time to buy? I wouldn't be doing that. I would simply enter and push price and direction, all of that. All right? So Smart Money concept is based on following the footprint of Smart Money. So you want to follow the footprint of Smart Money. That means, now, the good part about this is that, yes, we have understood the conspiracy, but there is a way to know what Smart Money would likely do and then follow them. So, for instance, now, either places I look at, and I know that I should not enter the market. If I see the market do something like this, all right? Now, what does this look like? Double top, right? Double top. For someone like me, I would know that smart money knows that. Let me tell you something. Smart money knows everything that you see on baby pips. They know support and resistance. They know all those trend lines. They know all those things. They know crossover. They know overbought. They know oversold. They know all those things. They know it. So, and that's why they use it to their advantage. So, if I saw something like this, I would anticipate that since smart money always look for how to make people to take the opposite side of their positions, what smart money would likely do was to move price and force everyone trying to sell at this double top to buy by taking their stop loss and then push price down. For someone like me, I would not take a trade in this kind of scenario. I would anticipate that smart money will take out this and then I sell and then join them and take price down. So that is it. So understanding smart money footprints does two things for you. Number one, it helps you to avoid unnecessary losses. And number two, it makes you to follow the big to make money, right? Number one, you preserve your capital by avoiding unnecessary losses. And number two, you make money because you're moving with the flow of the guys that move the market. Let's assume now that I am trying to cross a forest, a very thick forest. There are, a lot of trees. Like we have a lot of trees all over the forest. We have a lot of trees. You have a lot of trees. Sorry, this doesn't look like a tree. I'm sorry. You have a lot of trees, right? You have a lot of trees, right? You have a lot of trees, right? And me, yeah. This is me now, right? This is me. All right, I'm trying to cross this thick forest with a lot of thick bushes, right? I'm going to cross this forest. Now, would it be easier for me to cross this forest this forest? This is a forest, right? I want to get to the other side, right? So I want to get to the other side. Right? Forest. Man, can you imagine? Forest, not forest. So there's a forest in between me and maybe this is my destination now. I want to get to this destination, right? So I'm trying to cross from here to this point. Right now, and there's a thick forest in between me. Now, what are the chances? Is it better for me to go there alone or for me to get into a caterpillar and then cross this forest? The chances are that I would eventually cross this forest, but I might get fatigued or injured if I tried crossing on my own. But if I get into maybe a big caterpillar, right, a very big caterpillar that is bulldozing, that is pulling down the trees as it's moving. As the caterpillar is moving, it's pushing down all these trees as it's moving. The chances that I will have was a very smooth and, but I can't even be eating and drinking water as the thing is bulldozing the forest and going to my destination. So smart money is actually this caterpillar. So the best way to enjoy a stress-free trading is getting into the caterpillar while price moves. So this movement from here to here is the movement of price, right? So you want to be in where smart money is going. So smart money is trying to go to this point. You will enjoy a joy and smooth ride when you are trading in line with what smart money is doing, right? You want to be trading the same direction with the bank. You want to be trading the same direction with the hedge funds, the big guys. That's what you want to be doing. You don't want to be trading against them because the chances are always that you get clapped, right? If you guys are understanding what I'm talking about, just drop value, just type value so I can understand. I can know that you guys are getting. It's just value. You guys are getting, because value must be perceived before it can be called value. And if you guys are getting the whole gist, just type value. Type value. Let us know that you guys are getting the gist. All right. Let's go. Shush. Let's go. All right. Yeah, I see you guys. Let's go. All right. So that being said, Um, I mean, so now that being said, all right. So that being said, it's usually better if you can't beat money. It's not if you can't. Let me just change that. So it's not like it's not a debate. Since you can't beat smart money, it's not like it's not conditional. Since you can't beat smart money, join them. I just it. It's not a debate. If it's not as if you can beat smart money, you can you cannot beat smart money because they have more money than you. And this market is controlled by volume and the algorithm on the market. So since you can't beat smart money, the wisest thing to do is to join the 10% of traders that actually control the market. And that's what we call that. And now, since we have established that it's better to trade with smart money, then let us talk about institutional trading and liquidity concepts, right? Now, we'll start with liquidity concept before I go to institutional trading, and then we wrap it up for the evening, right? I don't want this part to be so long, yeah. So we're going into liquidity concepts. I've already talked a bit about institutional trading. I want to just talk about the liquidity concept, right? Now, what is liquidity? What really is liquidity? Now, let me just see you guys definitions in the group. So what is liquidity? What do you think liquidity is when it comes to forex trading? What do you think is liquidity? If you have heard about the word, just like it's in the group, what is liquidity to you? What do you think liquidity is? What is liquidity? What do you think liquidity is? Because before I want to know if you guys have an idea of what liquidity is. Let us see your comments in the group. What is liquidity? What is liquidity, folks? Right. Someone said liquidity is equal to stop loss, right? Someone said stop loss. Someone is sending an emoji. I don't quite understand what that means. All right, someone say where money is in the market. Wow, amazing. I'm see you guys are gurus here. I need to be very careful what I'm saying so I don't go and mess up. We must see gurus where the money is. They place guys into the market. Wow. Amazing. So you guys are actually very correct, right? Wow. I love that definition. Liquidity is the big money target to feed their orders. Yeah, correct. That's where money is. Money is the money that moves the market, and availability of money in the market. Yeah, that is an economic definition. That's economics. They are very acceptable, right? So that is it. So liquidity is all of what you guys say. Liquidity is money. That is it. That's what liquidity is. Liquidity is simply money. Right? It's money. The reason why Wikicat is pumping up is because people are buying Wikicats. The reason why Bitcoin went to as much as $60,000 is because the market cap went crazy. People were buying Bitcoin and pumping their money into the market. All right. So liquidity is just money. But as a smart money trader, we don't just see liquidity as money. We see liquidity as the location of money. Right now, liquidity is only money, but as a smart money trader, you are seeing liquidity because in these charts now we know that yes, there is money in the market. Let me just check something. I've forgotten the actual value. How much is in the financial market? I don't know how much it is. How much is currency in the financial market? I don't know how much they have currency in the financial markets. Last time I checked, it was 3.3. It was like $3 trillion or so. All right, I've gotten the exact figure. Trying to get it. It was $3 trillion as that. The last time I checked, I can't really remember how I got it. All right. Okay. Wow. Amazing. Wow. 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 As at comparison, the stock market had about $95 trillion. What am I seeing? Can quadrillion? Jesus. Okay, yeah, that's what I'm looking at. Yeah, that's what I'm looking at. So, okay, yeah. So, in the US financial markets only, right, we have $30.1 trillion as of 2018. As of 2018, we had $30.1 trillion. That was what we had in the financial markets. All right, so you said there's a lot of money. So now, money is liquidity, or liquidity is money, right? Now, as a smart money trader, you have to understand the location of money. You have to know where money is. Where does money reside? And your definitions are correct. Yeah, for you to actually maximize smart money concept or follow their footprint, smart money is always thinking liquidity and price levels. Right? They don't use indicators, right? So they want to know where the money is. And how do you know where the money is? Is by understanding the kinds of liquidity we have. So basically, we have 4 kinds of liquidity. Let's say 2. There are 2 actually. I want to call the external and the internal, right? And then under the external, we have under the internal we have the static. And that was the dynamic. There is the same case for internal too. We also have static and dynamic. I will explain a bit so you guys understand. All right. For you to actually understand smart money concept properly, you have to understand liquidity. Now, for instance, now, okay. Now, smart money, they want to know where people money is. For instance, now, if you are selling a double top, right? Where you are selling a double top, the chances are that your stop loss will be what? Somewhere around here, right? You will probably sell there, and your stop loss will be maybe probably somewhere around, just a little bit above it. So that area can be classified as liquidity. So that's wherever you put your stop loss is classified as liquidity. That's where your money is. Because whenever your stop loss gets hit, the market is going to do what? Collect your money from you. All right? And that's what we call a losing transaction. So wherever your stop loss is where your money actually is, not where your position is. So your money is actually where you place your stop loss, or where your account gets blown. For those who don't use stop loss, where your account gets blown, also where your liquidity is. But smart money knows that this kind of patterns. That's why I don't trade patterns. I don't trade head and shoulder. I don't trade double top, all those things, because I know that smart money knows all those things. They know double top, they know support and resistance, they know pennants, they know bullish flag, they know bearish flag, they know cup and handle, they know all those things, folks. They know all those things. That is why they use retail traders as their target. And sometimes you see a bullish flag and it's not good. Sometimes you see a trend line and it's not good, because smart money, they know it. So now, static liquidity is simply a liquidity or an area of stop loss that is at a fixed spot, while dynamic is moving, and usually it moves in form of a trend line. So dynamic liquidity is simply where people put their stop loss, or where people get involved in the market based on a trend line analysis. So why is it dynamic? Because it is moving. Dynamic simply means moving. So for someone that is buying this market, he's the person that bought here. The person that bought here will probably do what? Put his stop loss just below that point, right? Using the trend line, right? But someone that actually bought at a higher position, right? Someone that bought here would not likely use his stop loss this same place where person A uses. He's going to do what? Put the stop loss somewhere below the trend line, because the liquidity is moving. So another person actually bought here would also do something likely. He will buy here and do what? put his stop loss, a bit below a trend line, and then hold it up. So you can see that the liquidity is moving as the trend line is moving. That's why we call it what? The dynamic liquidity. It's always doing what? It's moving. It's moving. So these are traps in the market. They are traps that smart money target. That is why most often than not, you will see trend line get what? Violated, and then the price will run up, because smart money do. Smart money know that you want to buy this trend line. So they do what? They will manipulate price against you, and then do what? Push price there. So they force you to do what? To sell this market at a bad price, and then they can buy. So they want to buy, but they have to do what? You have to sell to them so they can buy from you. So they have to force you to what? To buy from them, and then do what? Take price higher. All right? So I'm just giving you guys the basis of smart money concept, so you guys understand this thing from there. In fact, what makes you a very good trader, in my experience, what makes you a very good trader is understanding the narrative. And the narrative is the why. Why did this happen? That is what really makes the difference between the traders that know what they're doing and the ones that don't know what they're doing. The traders that don't know what they're doing, they usually focus on results. They're focused on making profit. They're focused on flipping accounts. They're not focused on the why. Why should the markets buy? Why did the market is backtesting? Why did it happen? So I'm just giving you guys, this is how you become profitable, by understanding the narrative. Why did the market do this? And why would it likely not do this? You understand that? That is why, if you guys have watched me, I love selling against trend lines. In fact, I love doing this. I like this kind of trades where I will see market give a trend line and do something like this, and I'll give a BOS, and I'm seeing this trend line. So since I'm a smart money trader, I know that smart money wants to take out liquidity. So if I'm seeing this trend line, you guys can check my YouTube, my Telegram community. You see me place like this. Here I will see a trend line, here, and then I'll do what? I will sell and do what? Take out the trend line. A lot of this kind of thing, I will sell and clap it, because I know that this is what liquidity. So I know that smart money is doing what? They're usually targeting retail traders, and retail traders usually do what? They would want to do what? Buy a trend line. So for me, that I understand that the caterpillar would move in a certain direction. So I want to do what? In the caterpillar, which is smart money. So I want to be doing what? Selling with them and do what? Going to take out what? The trend line. That's how I trade. I like trading the opposite. If other people are buying, I'm selling. If other people are selling, I'm buying. That's how I trade. And I love trading the smart money way. All right? So dynamic liquidity and liquidity are what? They are moving in a trend line, in a moving fashion, like pennants, all those patterns. It's not only trend line. When it's something like this, you see something like this pennants. You see all this. These are all dynamic liquidity. Something like this pennant. They'll be like, I'm not if I'm correct. They'll be like, if it breaks out, it's going, all those things. Actually, what's it called? Dynamic liquidity. You have another one that looks like this. You say it's a bullish flag. It looks like this. Serrated pattern. Bullish flag. Blah blah blah. These are all what we call dynamic liquidity. All right. All this trend line, things that look like a line, right? They are what we call dynamic liquidity, right? So that is basically what that is. I've done more. I'm not able to cover all this so much because of the time we have. We're almost 1 hour into the call. So the video, I've done previous videos on liquidity on my YouTube channel. So you can always check out the YouTube playlist. There are a lot of beautiful and helpful stuff on the YouTube channel. All right. So now we have understood dynamic. Static liquidity is just the opposite. So if it's not moving, it's static. Right. If you're not moving forward, you're probably doing what? Stagnant, right? You're either moving, either you're moving forward or you're moving backward or you're stagnant. Those are the two positions that you can be. Like now, as I'm in a call, I'm sitting down at the place. Currently, I'm not moving. I'm not moving like physically, right? But we are moving intellectually, right? So you want to understand that if you're not moving, you're stagnant. So if it's not dynamic, it's static. So the static liquidity is simply all these double tops, it's at the one spot, triple bottom, other stops. These are all what we call liquidity, right? When you see in that, all right. So now we have understood that it's basically liquidity that stays at the spot, right? These are what we call internal static. Now, what makes an a liquidity, static and internal. Sorry, internal or static. So it's very simple. A static liquidity, sorry, an internal liquidity. Sorry, let me not say that. So in a bearish market, the market is doing what? Giving what? A lower high and lower low, right? Now, the external liquidity is the liquidity at what? The lower high, right? So we have your external liquidity what? Here. This extreme region, what we call external liquidity, and then your external liquidity is here as well. So here. So look at this is your external liquidity at the extreme regions, right? So look at the market has not made a new low yet, right? This is what the market was somewhere around. So you simply do was the mark was the highest point. Remember our market structure yesterday. I talked about lower high, lower low. If you have not watched the video, please go and watch it. I cannot go back to that again. All right. So external liquidity is simply what? The last lower high and the last lower low. That's what it is. Just very simple. All right. And for a bullish scenario, it's just what the last higher high and the last higher low. That's what external liquidity simply is, right? So it simply was the last higher low and the last higher high. Right, that's what external liquidity is. It's why it is what outside the trading range. So the trading range is simply between the last higher high. So for this market, the trading range is where from here to where? To this point. So anything outside the range is what we call external liquidity, right? A range is simply what? The distance between the last lower high and the last, sorry. A range is simply what? The distance between what? The last lower high and the mid lower low, sorry. I don't know something now, sorry. Back to our rules. You know that a lower high is valid until it has made a new lower low. So this market was still, this is not a lower high yet, right? So this is actually a lower high. Remember our rules. This is a lower high because a lower high must make a lower low. Since this lower high has not made a lower low, it's not a lower high. So this is becomes what? Our lower high. So that's our range. So this becomes our external liquidity, right? So this becomes our external liquidity because why? It has made what? A lower low. So a lower high must make a lower low before it can be called a lower high. So you mark the lower high and the lower low. So this extreme regions is also gives you your trading range. All right. So if you guys are following, just type following on the group. Just type following. Just type following on the group. So I can know you guys are following. If you guys are following, just type following on the group chat. So I can know you guys are following. Right. All right. So yeah, you guys are following. Let's go. Someone is not following. It seems you just joined the call. Don't worry. This thing might be too advanced for you at this level, right? It might be too advanced at this level because these are actually stuff that are actually quite advanced, right? You might need to watch the recording over. So what I'm saying is that we must go by it. I'm saying that in a bearish market, if you have not watched yesterday's call, that's why you're getting confused, right? That's why you're getting confused. If you're not watching yesterday's call, I said that in a bearish market, you have your lower high and your lower low, right? And the reason why we did not use that previous one as the lower high because why? It did not make a new lower low. Remember the rules I gave you guys. And the lower high must make a new lower low before it can be called a lower high, right? So between this last lower high and last lower low, we have what? Your trading range. So you simply draw a line between that point and this point. So the external liquidity is why? Is something that's outside the range. So from here, from this point to this point, what is your trading range, right? This distance from here to here. So since this point is outside the range, it becomes what? External. Outside the range. That was the word external. So that makes it what? The external liquidity. So it's the same thing for a bullish market. It's just a reverse. So you're going to do what? You're going to mark what? The range. Yeah, remember higher low and higher high. So you mark the range. And those red spots are what we call the external liquidity. The black spots, the red spots. So anywhere outside is what we call external liquidity. All right. And that as a smart money trader, the best place to put your stop loss is at the external. Like your stop loss should always be outside the range. That's how to trade. Right? Even you're trading in a lower time frame, if you are using a 15 minutes time frame, 1 minute time frame, the best place to put your stop loss is outside the trading room. That's usually the best place, right? So now, since you have understood external liquidity, what about internal? Internal is simply what? Anything inside this range. So let's go back to this point. Let's go back to this point. So now we know that outside the trading range is the external. So inside is what we call the internal what? Liquidity. So now, you know that at times the market will do something like this. You see market doing one front, the market will do something of double top here. It's not because it's rejecting. And then stock can finally fire up and then go down. So what the market was doing here, it was trying to induce you to do what? To sell inside what here and then liquidate and then goes back down. So anything, any area of rejection you find inside the market, inside this range, what we call internal. So our internal liquidity based on this, we have what here. This is internal. This is internal because people want to buy it because they think it's a support level, right? This is internal. That is internal. That is internal. Why? It's inside a trading range. So whatever is inside this trading range between the last lower high and the last lower low can be classified as internal. So it could come in form of a trend line or just areas of rejection. So you can say a dynamic liquidity trend line here, that is internal, that was dynamic liquidity, right? So in any area of rejection, where you can, any kind of pattern, whatever you see inside a trading range, usually it is what internal liquidity. Usually internal liquidity is usually trapped, especially when they are countered. Now the market is bearish, right? You're seeing a bearish market on this chart, right? The market is bearish, right? And then finally you're not seeing something like this. You're not seeing the market do something like this, giving a kind of double top here, and then you want to go and buy, market and liquidate you. So what the market was doing was creating what? Internal liquidity. So it was creating what? It kind of trap. Market is bearish. Why should it be creating a kind of support level inside a bearish market? That's what we call internal liquidity. And this kind of thing that means you should avoid it. So you are avoiding structures that are not in line with the overall trend. So now we have known the market is bearish, and now you can identify this whole support level is actually what? A trap. So you can see that most times you do a kind of rejection, kind of bullish candle. That's why I don't trade candlestick patterns. Sometimes you see it's an engulfing candle here. I'm not going to do this, drop down, right? So whenever I speak on something, I'm not really worried because I know that this is most likely what? An internal liquidity, right? So that is it. So it could come in form of a trend line and all of that, right? So let us talk about institutional trading, right? I've told you guys about liquidity. So now we have understood all this. Now, how do we actually maximize this? I'm just going to teach you guys just one smart money concept, which is actually the most popular one. There are other ones which I use, right, which I also taught on the free YouTube channel and also in the paid mentorship. But I'm going to teach you guys the one that I use most often, right? And that is the most basic smart money concept, right? And that's what we call and this particular thing I want to teach you guys has changed my trading. Like it turned my trading like for the better when I learned about this concept. So we have what we call the smart money institutional candle, and this is the meat of this call. So I might not be able to talk about the algo trading because it will take me a while to start explaining all of that. So because of time, I have to stop with this. I won't talk about the algo trading, which was supposed to be the last part of it. Right, I'll just leave that maybe for tomorrow. I can just talk to you about it and all of that, right? And those things I actually taught in our paid mentorship. We actually teach us all those stuff, right? We actually have a lot of. This is why no matter how hard we try, boot camps cannot really be so cannot really touch everything you need to touch because of the time constraint, right? This is something that you need to be taught periodically over and over again, months and months in. So that is basically it. So this call is just basically to put you guys really calibrated, to filter your belief system, to push out those things that you have been holding dear, which have been, sometimes the things you hold dear are the reasons why you suffer. Those things you're holding dear. So some things you have held there. For instance, I feel that is indicator trading is one of the worst things you could be doing at this stage of your life. If after attend this coin, see trade indicators, then you know cause of the problems. Because smart money, they don't look at your moving averages, your 200 MA, exponential blue MA set to close, weighted, all those funny moving averages. They don't use it. They don't use all those things first. They are looking at liquidity. They're looking at where they can liquidate traders. That's what they're looking at. They're looking at imbalances. They're looking at this. Right. So now, the smart money institutional candle. A smart money institutional candle. I've told you guys that I asked you guys. I started this call by asking you guys that have you been in a trade where you are trying to sell and the market does what? You're trying to sell a double top. The market does what? Spikes against you and then start dropping heavily. Right. So this is what we call an institutional candle. So now, an institutional candle can be defined as the candle or the series of candles. So I'm just typing this out. I told you guys that I will make a PDF, right? I'll make a PDF to explain this course. It will be my free gift to you guys, right? So you guys will post your email after all this course, right? You will post your email, right, on our newsletter, whatever. We're going to take your emails and then we're going to send you guys a PDF. I'm going to customize, put all this information in a kind of handbook format where you can always look at, and then it will just be very brief and summarized. Right? I'll just make it very brief with pictures, everything so I can actually understand. So that will be my free gift to you guys that attended this call, right? It's come to your individual emails. It will be posted on the general group so that those of you that actually attended the call can just simply have access to the free PDF which will be giving you guys, right? So if you don't understand certain things, the thing will be well explained, or let's say summarized in the PDF. So you just drop your email after Sunday's call. I'll send the link. You guys can post your email, and then we'll send the Elektron FX handbook, right? So you can always have all these things at the tip of your hands, right? So institutional candles are candles. They are candles, all right, that has intent. So they're candles with intent, right? And what's the intent? The intent is what? To liquidate traders. So institutional candles are candles with intent to liquidate traders in order to pay their their orders. All right. So this is what institutional candles are. Right. This is what basically candles with intent. Right. They are candles with intent. No one put that way. Candles with intent. Right. They have a reason why they are printed. Right. They are candles with intent. Right. So and what intent? To liquidate traders, right, in order to pay their orders. Their orders should be THIR, not right. How to pay their orders. So what am I saying? So smart money wants to, smart money wants to actually sell this market. But what do? They have to do what? Buy against you. Remember I told you guys that smart money have to manipulate price. How do they manipulate price? By doing what? Going the opposite direction. That is, if they plan to sell, they're first going to do what? Buy against everyone else. Then pair their orders with what? Their sell order, and then they now take price. And that means they will have a sell limit somewhere around there. So they're going to now do what? Buy here to that sell limit and then dump price. So they are also even helping you to pay the orders, right? They will even help you and buy. So they will even join and buy. Well, so stop loss is hit, you have joined them to buy. So as they're taking your stop loss, both their buy order and your stop loss also contributing towards to pay their sell orders, right? So those candles that take out stop loss before going the opposite direction are what we call the smart money institutional candle. Now, note something that let's assume that smart money came here, right? They want to take out stop loss, and then at this point here, they bought with 5 lots, right? Imagine that they bought here with 5 lots, so they can take out maybe let's assume that everybody in the world, their own order was, let's say, 5 lots, and then smart money come and was buy with 50 lots, right? 50 lots buy. So they buy with 50 lots. Take this down. So let us understand this now. So smart money was let us know that everyone in the world we are selling with maybe 30 lots, and then smart money they come and buy with 50 lots, right? market is going to go against you because they have enough money to do what? Push price against everyone in this world. Someone who can push price against everyone else in this whole world. Even if all the data stand together and begin to trade, can you trade against a bank? If you are speaking now, your money is in the bank, right? Someone is using your own money to trade against you. You see that most of your savings are in the bank. So they've been using your own money to trade against you, and then they can even print money. They can take loans from the World Bank. So these guys have the money to move price against you. So even if everybody in the world was selling and smart money buys, they are going to see what push price against everyone else because what they have the money. So imagine what I just told you guys that in the United market they have $30.1 trillion. So imagine that someone that has maybe out of this 30.1, someone that has about 10, come and buy, and you're using your $100 small account to sell. You're going to get roasted. Can someone just type roasted on the group chat? Just type roasted. Type roasted. So I don't know you guys are following this call. Just type roasted on the group chat. So I don't know you guys are following. You're going to get smoked. All right. So, wow, amazing. I love how you guys are following. Let's go. Shush. Someone put the meat. All right. So there's no way that your $100 or your $1,000 is going to push price against every other person. You're going to get roasted. So if they buy against you, now at this point, what did I do? Remember, they wanted to sell. They had a sell limit here. Right? It's maybe 5. Let's say they were selling here with. They were selling at this point. See, this is how to actually master trading. Understand the narrative. Just leave charts. Just understand why the things are happening. So now, as soon as they now come and do what? Sell with. They now do what? So they buy their buy position also helps to pair with their what? What have I done? So they now come and do what? They come and do what? Sell with what? 500 lots. So now they're able to pair their buys with their sells, and then they have 500 lots sell at this point here. So they bought against everyone else, and then now sold 500 lots. So price that it was, it now went up and then bounced down. All right. So when price bounced down, their sell is in what? Profit. What of their buy is in profit? Remember that they bought here to take traders out, and then they now sold somewhere around there. Is their buying profit? This buy, when price comes to here, is their buying profit? When price comes here, remember they bought here, and then sold above it, and they have 2 positions running at once. So, is their buying profit? Just type it the answer in the group. Is their buying profit? When price comes to that region I just marked, is their buying profit? Just type in the group if you know the answer. Is it in profit? I mean their buy position, not the sell. No, I said they bought here and they sold here, and price is there. Remember, they have a buy running here. Is that buy that they bought here? Is this buy that is here? Is it in profit when price is all the way down here? Is it in profit? And some people are saying yes. Maybe maybe this is kind of you need to smart money. Or some people are saying yes. All right, let me explain it now. Okay, yeah. All right. So if you are buying here and price all the way down here, you're in a loss, because when you're buying, I told you in yesterday's call that when you're buying, what market to be doing was to be going up. You make money in a buy when price is going up, not all right. Right. $500 sell. So you make money in a buy when price is going up, not when it's coming down. So if smart money bought here and they sold here, they have 2 positions running. Their buy is in a loss, but their sell is in profit. Now, remember that smart money is trading with what? Trillions of dollars. So their loss is not going to be $10 loss. It's not going to be $1,000 loss. It's going to be running in millions. So that's how their loss will be running. So their sell is in profit, but their buy is in what? Drawdown. And smart money cannot afford to be losing even $1 trillion on a single trade. So what did they do? they're going to do what? Push price back to where they bought, so they can be able to do what? Close their position. So that is where we, as smart traders, now get involved. This is where we get involved. So now, remember the story that people were going to sell at this double top, smart money bought and then sold above it, and then they have to do what? Since since their buy is in loss, they have to do what? Push price back to where they bought, so they can close their buy and then add more sales. Since they have taken everyone else liquidity and their sellers have been activated because they needed people to take the opposite side of their trade. So they have been able to take your liquidity, your stop loss, and then their buy is in loss. The buy that they used to do evil. So that buy is also what to call the institutional candle. That buy that goes against everyone else before going the overall direction, what we call the institutional candle, right? So since they bought here and then price going down, they have to do what? Take price back to this point to close their buy, right? So they have to take price back to where they bought, so they can close their buy in break even or maybe a little profit, right? So this is where you get involved. And when they close their buy here, you're going to do what? Likely do what? Take price lower. All right. Now, as a smart money trader, there are two places you want to get involved in this market. You want to either get involved when they take price back up and they're about to send price down, or you want to get involved when they were selling originally. But the technicalities in getting involved at this original sell is something that you must really be very advanced in algorithm trading to be able to do that. So I'll just stick to the basic one that is very relatable for basic guys. But sometimes I used to actually catch sales when someone is dumping just at once. I used to catch it and then build POS. But I won't talk about that aspect, right? Because it's very confusing. So just understand that when smart money have a buy that, just know that anytime a candle takes that stop loss, that candle is in loss. And price has to come back to that candle to do what? Close that position in loss before taking price down. Notice something, that when price did this, what happened? We had what? A break of structure here. So this is what makes an additional candle valid. So you want to see price take out liquidity and then break structure. So this is going to be convinced that this market is what? Bearish. Right before you say, remember that you want to be selling in a bearish market. So the market is able to do what? Break structure. That means the market wants to do what? It really wants to do what? It really wants to sell. So that is what you know that, okay, I want to join this sell. So you want to see markets take out liquidity and then break structure downwards. So you have a BOS, meaning the market was bearish. So when price comes back, and smart money, they know, this is what smart money follows. Smart money knows market structure and they follow market structure a lot. So smart money, they usually do what? They trade with market structure, right? This is the only thing that they use. They use market structure. So you want to see price break structure and then come back to where they had that what? Loss running. And this is where you get involved. So there are three ways to get involved in a smart money institutional candle. The first way is to get involved what? At the open of the institutional candle. So you can play the open of the institutional candle. I can put a limit at the open of it. So you can play the open of the institutional candle, right? So you can play the open of the institutional candle. And if price comes, you can put a limit at this point. Since that market is bearish, number one, you want to see market take a liquidity. Number two, you want to see a break of structure. And number three, you want to see price coming back to where that buy was. That buy that needs to be closed because they can't close in $300 loss. So you want to put your limits at that open and stop loss above the high, right? Or above, if you can find a feel of an imbalance, now let's put above an imbalance. I won't talk about that one. I won't go too far about imbalances, but I've also done videos on that. They're all on my YouTube channel, right? So I won't talk about imbalances here. I don't talk about institutional trading. So you want to put this is actually what has made me a lot of money. I'm talking a lot of money, this concept. So you want to be taking your sell. Remember, it's that everything I've taught you, I did not mention indicator. I did not mention crossover. I'm not teaching you guys how to see price from naked charts. So you're looking for market to do what? Do this. And then to take price where? At this point, put your limit at the open and then maybe possibly 0.03 or whatever you use. Tomorrow, talk about risk management. Right? So this becomes your first area, and that's the first way you can enter. The second way you can enter this trade is what? At the 50%. So you want to enter. Sometimes smart money can be greedy, right? They can be greedy and want to take at 50% profit. So that means instead of them to close their trade at break even, they want to allow the trade to go up a bit, maybe enter small profits, maybe enter a bit, because if price is said in kind of small profits, so they might want to allow price to hit profits, like go to a profit level, and then they close in small profit before selling. So this becomes another area of entry. You can also choose to play what 50%. Most times I use 50%. Most times when I see an imbalance or even I see a bank number, right? So I won't really talk much about that, right? Something that we have taught in, I think, our private mentorship and all of that. So you guys just get the point here. When price, these are the two, you better play in short candle at the open of it, at the 50%, all right? And the third way to play this is what? To wait for lower time frame confirmation. So you have to do what? This is the third way you can play it. You can do what? Wait for lower time frame confirmations. All right. So this is the third way you can play in short candles. You can play it this way, or you wait for lower time frame what? Confirmation. So these are the three ways to play institutional candles. Either you play the open of it, I just mark the open of the candle and put your stop loss above it, or you play the 50% and stop loss above it, or you do what? You wait for price to give you a lower time frame confirmation. That means it could be a break of structure, it could be a candlestick pattern, it could be an ICT fair value gap, it could be a shift and failure swing. Any of those confirmations to use. There are so many confirmations to use, right? I've done a video on just one of them, right? That's actually a video I made on my YouTube channel. You guys have to really get used to watching videos, right? Just get used to it, because I cannot teach everything on one single call. It's not going to be possible to teach everything on one single call. I'm not trying to filter the most important part of the whole stuff for you guys to get. I'm not fitting out the most important part, right? I cannot teach everything here because I don't have enough time. And some of these things are actually private information, all right? So you want to targeting the 50%, the open, or you wait for what? A confirmation on the lower time frame. It could be a candlestick pattern. For those of you candlestick pattern, I didn't say it doesn't work, but in this context, that's why it works. Maybe see an engulfing candle, you can maybe play it, get involved in engulfing candle. If you are like lower time frame break or structure, you can use that. If you like failure swings, you can use that. If you like total sweep, you can use that. Whatever confirmation. If you like imbalance, if you see an imbalance, they want to play an imbalance. I did a video on imbalance previously about 1 month ago or so. Talk about imbalance. So you can use an imbalance, whatever you want to use here for your entry. So now we have understood this. Let us go to two real examples. I've been talking. Let's look at 3 charts to see if I'm actually saying the truth. Let's look for where we can find an institutional candle, right? So let's look for institutional candles now. Let's look for it. All right, let's go. Let us see where these candles played out. Can someone else type "let's go"? Because this is where you enjoy this call. Can someone type "let's go" on the group chat? Just type "let's go" because you're about to enter the practical aspect. Just type "let's go," because we're about to fly now. This is going to change a lot of you guys. I'm telling you guys that this is what is going to change your trading. Like this thing I'm teaching you guys is what is going to really change your trading. This is what really changed a lot of my trading. This is what my trading is mostly based on. Most of my trades. Let's type, if you're ready for this, just type "let's go" on the group. Just type "let's go." All right. So now look at this carefully. Now notice something. Now we're combining both market structure and everything I taught you guys previously. Now, what can you see here? The market was what? Bullish. So you can see the market was bullish. Obvious. What do you have here? Bullish market. Higher high, higher low, higher high, higher low. Now what happens here? Look carefully. Just look carefully. This is just going to be a very sweet example. Look at this. Pay attention. Now, market was bullish, but something happened here. Number one, you can see that. Look at here. At this point here, market was giving a kind of rejection. Can you see what I'm talking about? See, I just explain now. See, market was giving a kind of rejection. So people that saw this will be like, this should be a resistance level. So let us sell the market. Let's sell. Just dump retail traders, right? So they would like sell. I was once like this. When I saw this, I was like, man, if I see this kind of sell, I was like 1 touch, 2 touch, sell. That's how I was before. And when I stopped loss above it. But look at what happened. Can you see these 2 healthy candles? These candles that look like they've been eating their mother's diet. They are so healthy. Like, look at what happened. 1, 2. Look at this candle. What did he do? Took out what? Look at what? And then what do you see? We had what? a break of structure. What do we have here? When market takes out the last higher low, you can see a price closed below it. Right? Look at the close price. Look at the close price here. What do you have here? A close. Now you can also use your line chart to confirm it. You come to your line chart and then look at the line chart. What do you have here? Market did what? It went below your last higher low. So you was always add market structure to whatever you're doing. So now we now have what? An institutional account. The same thing is for a buyer. So this thing happens also for a buyer. So I'm not using sales. So now you mark what? The institutional candle. So you can play the open like I told you guys. So you can mark this is the open of the candle. So you extend it in time. And you know that candle is in what? Drawdown. So the price come back there. Let us see. Let's see if price came back there. Let's see. So price actually paid around the beats. Let us see. But let's mark that price level. Let's mark the price level. Let us just mark it. Right, somewhere around there. So nice to use the week. Nice to use the lower week. But once I go for the open. Because most of the candle volatilities are at the open. So let's see if price came back there. Let's see. Can you see it? This is it. So can you see how smart money came to where they bought? So this was where smart money actually bought this market at this level. So can you see that after all this, look at how they created liquidity again. You can see that as people saw this, look at another liquidity here. It was what we call internal liquidity. Now, I want to combine everything now. So when the market broke structure, we have was our range from here, all right, and then our range low was what here. So like I said, all these things was what we call internal liquidity. You can say they were creating what were they creating here? They were creating what? Support level. Right, they're creating support level here. And what did they create here? A resistance level. Can you see it? Can you see how smart money is always taking your money? So they created all this liquidity. Look what happened. Look at price ran up and then finally was ran down. So as simple to that, you're not interested in all this. You're not paying attention to all this bullshit, right? You're focusing on what smart money is doing. So you have what we call selective blindness. So for me, I am selectively blind. I only look for what I'm looking for. And what I'm not looking for, I'm not looking for it. All right. So I'm only focused on this kind that took out towards liquidity. So you can see that market came there. And what happened? It dumped. And you can see this massive jump. Now, let's assume that you played the open of the candle. What would you have had? You have played the open of it here. And then put your stop loss above the candle. And then you would have made 4.12. Right? For me, I'm targeting this. Look at liquidity here. So you're targeting this low here. Though you did not hit it at all, but or I'm targeting that, but you didn't hit it. So this you have made a 1:4 on this. Wow, I said price. So I see something now. There's an imbalance here. So we have likely gone for the imbalance. So now we can say that price played this. So now let's assume we want to play 50%. So you can simply bring out your gun box and just measure 50%. So you can under 50% of this. Just simply do what 50% of this. Now just measure 50%. And then put my stop loss, my limit at 50%, somewhere around there. So can you see how 50% was very neat? And 50% gave 1:8.1. So you can see how smart money concept actually is very easy. Imagine that you are a dump. Some of you are being delivered tonight. So some people have been buying the support. You just heard and finally broke through. But look at how precise this was. Market just came there and dumped. So you are not interested in all these traps. You're not interested in internal liquidity. You want to be selling when the market is bearish. And the only sell opportunity to me is what? As this institutional candle. That is the only sell opportunity on this market. And you can sell price came at 50% perfectly. Bam! Gave 1:8. So that is basically the only example we're talking about. So you guys would have to go and identify the ones for bullish ones. Look for where price gave this and broke structure and then came back to touch it. And you will see how beautiful this was. This thing works on the higher time frame, on 1 minute, on 15 seconds, every single time frame. It works there. So now let's talk about lower time frame confirmation. So basically, lower time confirmation is simply seeing a BOS on the lower time frame. That means when the market comes inside there, you want to see the market do the same thing, do higher high, higher low, higher high, and break. So you want to see maybe this is a 2-hour time frame, right? You want to see a 15 minutes time frame or maybe a 5 minutes time frame, do this same break construction inside there. So you can use the lower time frame as what? Confirmation. Or even if you use candlestick pattern, that is basically one of them. So there's so many confirmations you can use, but the one I like using is what we call the evidence of redistribution. So you want to see market give this BS maybe on the 15 minutes inside there. So when the market comes where, so in that kind of confirmation entry, you're not entering with the limit, right? You cannot simply wait. When price hit this lower level, right? You're now going to look at your charts. You're going to look for what market to do was give a higher high, a higher low, a higher, and what a break. So you enter with the lower time frame confirmation, then it's short, right? I've done more videos on that, and that is why we're wrapping up the call. So if you guys really got value on this call, just type value because we're about to wrap the call up here, so you can prepare for church tomorrow. All right, so just type value on this call. We're about to wrap the call now. Just type value, 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 value. If you guys really enjoy this call and you learned something so significant of this call, right? Just type value, right? Let's type value. You can see how this is pan out even on Richard. All right, so amazing, 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 amazing. So you can see that this is how smart money actually trades, right? So there are actually so many confirmations which I have taught the private students. I can't really start bringing up others on this. That is why I said earlier that boot camps are more like bringing you aware of the things, right? You need to really see these things more often and all that. So I can't really talk about other confirmations. Let's talk about just one model, right? So there are actually other smart money concepts beside instrument candle. But I brought this one up because this one is the one I use most of the time. This is the one that actually play out most often, right? You usually find this candle taking out stop loss and then running down. You usually see very often. So there are actually other smart money concepts which I did not mention here, right? And those are they're properly taught in our paid mentorship program, right? So if you just do well to watch my YouTube channel, you can see more of all these things that we talk about and all that. So tomorrow call, we are going to go a little bit deep. We're talking about algorithm trading, talking about risk management, and we're talking about trading psychology because psychology has a lot to do with what trading, right? So these things I taught you guys, just do well to go to your charts and look for them. So the task is going to just be one, right? You're going to just have one task. Or let's say two tasks. This is the task I could not type it out earlier, right? I couldn't type it out earlier. So you have two tasks just to type. This is just to make you guys to go to the chart and look for it. It's not just see in trading, you cannot just watch a video and automatically begin to have results. You must go to your chart and look for what they're talking about. So you have just two tasks. Identify the dynamic and static liquidity for external. And you want to look for the external one and internal. So you have to do those little tasks you guys have to just do. They help you to go to your chart and look what I'm talking about. Right. So I like the first task. Then the second one and the final task was identify identify bullish. Right, the one I illustrated was a bearish one because the letter was a sell. So identify bullish and bearish institutional candles, right, that led to a BOS, a break construction, right? So you're not the one that led to what? A break construction. That's what you're focused on. So you want to see a institutional candle break structure, not just liquidate high. You must see it break structure. So you're sure that you're trading in line with what the trend, right? So the trend is your friend. It's always your friend, right? So identify the kind of liquidity we have for internal and external, and then you look for bullish and bearish institutional candles. So tomorrow you're going to be wrapping up on this call. Tomorrow you're going to be wrapping up with the call tomorrow, right? So I hope this call was insightful. See you guys in tomorrow's call. Just do well to do the assignments, please. Please this year say no to signal services. Say no to all those copy trading money account. These things are not the way to grow because I've never seen a doctor that goes to say, please, sir, can you, as I'm doing the surgery, can you just be showing? Can you be telling me what to do on the phone? Does it happen that you're doing a surgery? Maybe you're doing a surgery, and then I'm saying, please, sir, can you be telling me what to do on the phone? Let me just be copying what you're saying. It doesn't happen. You do it on your own. So you must put this skill, right? And it becomes part of you, all right? It becomes part of you. right, so I hope to see you guys on tomorrow's call. Do well to invite your friends because tomorrow is going to be the wrap up of this meeting. All right. If you enjoyed this call, do well to share the link with your friends. And if you want to join our paid group where we talk more about these things, you can always contact me for that. All right. So see you guys on tomorrow's call, and I hope it was insightful. Cheers and God bless. Don't forget to join the YouTube channel because we have a lot of free stuff. For those who like free stuff, right? You can join the free YouTube channel. But if you want to really get in depth, we have our paid mentorship program, which we go deep into all these things, right? So, and we have a library group where we have more than 100 recorded calls. Like I'm telling you, 100 recorded calls of all this. Imagine watching my videos 100 times, and they're all different. There's no way you can ever be the same. Right? So, see you guys in and God bless.